Today we learn about foreign exchange markets. So what are foreign exchange markets first of all? A forex market or a currency market or a foreign exchange market, it is a global decentralized or over-the-counter market for the trading of currencies. The currencies which belong to different countries. Now this market determines foreign exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at current or determined prices. In terms of trading volume, it is by far the largest market in the world, followed by the credit market. The main participants in the market are the larger international banks. Financial centers around the world function as anchors of trading between a wide range of multiple types of buyers and sellers around the clock, with the exception of weekends. Since currencies are always traded in pairs, the foreign exchange market does not set a currency's absolute value, but rather determines its relative value by setting the market price of one currency if paid for with another. Like, for example, one US dollar is worth X CAD, that is Canadian dollar, or CHF, or Indian INR, Indian rupee, or JPY, that is Japanese yen, etc. So, the foreign exchange market works through financial institutions and operates on several levels. Behind the scenes, banks turn to a smaller number of financial firms known as dealers who are involved in large quantities of foreign exchange trading. Most foreign exchange dealers are banks, so this behind the scenes market is sometimes called the interbank market. Although a few insurance companies and other kinds of financial firms are also involved in this. Trades between foreign exchange dealers can be very large, involving hundreds of millions of dollars. Because of the sovereignty issue when involving two currencies, foreign exchange has little supervisory entity regulating its actions. The foreign exchange market assists international trade and investments by enabling currency conversion. For example, it permits a business in the United States to import goods from European Union member states, especially Eurozone members, and pay euros even though its income is in United States dollars. It also supports direct speculation and evaluation relative to the value of currencies and the carry trade speculation based on the differential interest rate between two currencies. In a typical foreign exchange transaction, a party purchases some quantity of one currency by paying with some quantity of another currency. The modern foreign exchange market began forming during the 1970s. This followed 3 decades of government restrictions on foreign exchange transactions under the Bretton Woods system of monetary management, which set out the rules for commercial and financial relations among the world's major industrial states after World War II. Countries gradually switched to floating exchange rates from the previous exchange rate regime, which remained fixed as per the Bretton Woods system. The foreign exchange market is unique. Why? Because it has certain characteristics. And what are those characteristics? One, it it's huge trading volume because there are so many countries involved. It represents the largest asset class in the world's leading to highest liquidity. Then it's geographical dispersion. So there are so many geographies in which it is working. It's continuous operation because if at one place there is night, in the other place it's day. So in India it is day, in United States it's night. So it works 24 hours a day. Also the variety of factors that affect exchange rates, because as many number of countries, as many factors are involved which will influence the exchange rates. Then the low margins of relative profit compared with the other markets of fixed income. Also, the use of leverage to enhance profit and loss margins and with respect to the account size. So there are huge account sizes, and hence there is usage of leverage which makes it unique. Also, it has been referred to as the market closest to the idea of perfect competition, because currency intervention by central banks makes it such a perfect competitive market. According to the Bank of International Settlements, the preliminary global results from 2019 triennial central bank survey of foreign exchange and over-the-counter derivatives markets activity show that trading in foreign exchange markets averaged $6.6 trillion per day in April 2019. This is up from $5.1 trillion in April 2016. Measured by the value, foreign exchange swaps were traded more than any other instrument in April 29 at $3.2 trillion per day, followed by the spot trading at $2 trillion. Which are the instruments of foreign exchange markets? The instruments that help the international payments are: one, checks and bank drafts. So persons dealing with foreign exchanges can use bank checks as well as bank drafts in order to make payments. The check is drawn on particular bank instead of a person. Then bills of exchange. It is also called as foreign bill of exchange, which is an unconditional order in writing addressed by one person to another. It mentions the person to whom a certain sum is to be paid either on demand or on specific date. Third is mail transfer. Under this, funds are transferred from one account of a destination to the another destination in the nation by mail. For international payments, air mail is used. The last is telegraphic transfers. By this method, a sum can be transferred from one place to another place in the world by cable or telex. This is the quickest method of transferring funds from one place to another. Thus, these are various instruments or methods used for reflecting or inflecting international payments. Now, which is a very new instrument is also there, but its legality is still questionable, and which we'll not cover here. What are the functions of foreign exchange market? First is transfer function. So the foreign exchange markets are exchange markets engaged in transferring the purchasing power between two nations and two currencies. Its prime function is very simple. It is conversion of one currency into the another, such as converting Indian rupee into the US dollar and vice versa at some rate. Various instruments like bank drafts, exchange bills are used for transferring the purchasing power. In this regard, international clearing to both the directions is important because it simplifies the conduct of international trade as well as capital movements from one country to the other. The second is credit function. Under this function, the foreign exchange market provides credit to the traders such as exporters and importers. Exporters can get credit such as reshipment and post-shipment credit. Recently started euro-dollar market is a leading credit market at international level. This function of making credit available plays a crucial role in growth and expansion of the international trade. The third function is of hedging. Hedging is a very specific function because under this function, the foreign exchange market tries to protect the interest of the people dealing in the market from any unforeseen changes in the exchange rate. The exchange rates, that is, the price of one currency expressed in the terms of another, under free market situation can go up and down. This can either bring gains or losses to the concerned parties. Foreign exchange market guards the interest of both exports as well as importers against any changes in the exchange rate. Therefore, these are the various functions, that is the transfer function, the credit function and the hedging functions, which are performed by the foreign exchange markets. And this is how the foreign exchange market works. Now, what is the meaning of exchange rates? The concept of exchange rate has great significance because, in case of the open economy transactions, there is an existing of at least two currencies. Exchange rate refers to the price of one national currency expressed in terms of any other foreign currency. External economic transactions need an essential symmetry between the two currencies. So, what is an exchange rate? It is the amount of foreign currency that may be bought for 1 unit of the domestic currency. It can also be defined as the cost in domestic currency of purchasing 1 unit of the foreign currency. Now, suppose if the exchange rate between Indian rupee and US dollar is 1 rupee is equal to $0.02 or $1 is equal to, let's say, rupees 47. It simply means the value of 1 Indian rupee is $0.02127 or $1 costs rupees 47. Thus, the exchange rate is the price of one currency expressed in any other currency. In order to simplify the fulfillment of international transactions, an expression of each exchange rate is must in external economic transactions. Suppose an Indian importer wished to import goods from New York. Then he must convert his Indian rupees into United States dollars in order to make payments. However, on the other side, when the US importer buys goods in India, then he has to convert US dollars into Indian rupees. The rate at which this conversion takes place is called exchange rate. Now, how this symmetry between two countries is expressed? How the exchange rate is determined is mentioned, and we will find it out in our coming discussion. And to understand that there are two fundamental types of exchange rates, those are spot rates and forward rates. Before knowing about the spot and forward rates, let's first of all go back to the history of the foreign exchange rates and markets. So, the currency trading and exchange first occurred in ancient times. The money changers, helping others to change money and also taking a commission or a charging fee, were living in the Holy Land in the times of Talmudic writings. These people used city stalls and at least times the temple's code of the Gentiles instead. Money changers were also the silversmiths and goldsmiths of more recent ancient times. During the 4th century, the Byzantine government kept a monopoly on the exchange of currencies. Papyri shows the occurrences of exchanges of coinage in ancient Egypt. Currency and exchanges were important elements of trade in the ancient world, enabling people to buy and sell items like food, pottery, and raw materials. If a Greek coin held more gold than Egyptian coin due to its size or content, then a merchant could barter fewer Greek gold coins for more Egyptian ones, or for more material goods. This is why at the same point in their history, most world currencies in circulation today had a value fixed to a specific quantity of a recognized standard like silver or gold. International trade. Motivated by the onset of war, countries abandoned the gold standard monetary system. Let's come to a more modern approach to the postmodern. From 1899 to 1913, holdings of countries' foreign exchange increased at an annual rate of 10.8%, while holdings of gold increased at an annual rate of 6.3% between 1903 and 1913. At the end of 1913, nearly half of the world's foreign exchange was conducted using the pound sterling. The number of foreign banks operating within the boundaries of London increased from 3 in 1860 to 71 in 1913. In 1902, there were just two London foreign exchange brokers. At the start of the 20th century, trades in currencies was most active in Paris, New York City, and Berlin. Britain remained largely uninvolved until 1914. Between 1919 and 1922, The number of foreign exchange brokers in London increased to 17, and in 1924 there were 40 firms operating for the purpose of exchange. During the 1920s, the Cleanwood family were known as the leaders of the foreign exchange market, while Joseph Montagu and Company and Seligman still warrant recognition as a significant foreign exchange traders. The trade in London began to resemble its modern manifestation. By 1928, foreign exchange trade was integral to the financial functioning of the city. Continental exchange controls, plus other factors in Europe and Latin America, hampered any attempt at wholesale prosperity from trade for those of 1930s London. After World War II, in 1944, the Bretton Woods Accord was signed, allowing currencies to fluctuate within a range of plus minus 1% from the currency's par exchange rate. To remember, it was the time of fixed exchange rate. In Japan, the Foreign Exchange Bank law was introduced in 1954. As a result, the Bank of Tokyo became a center of foreign exchange by September 1954. Between 1954 and 1959, Japanese law was changed to allow foreign exchange dealings in many more Western currencies. United States President Richard Nixon is credited with ending the Bretton Woods Accord and fixed rates of exchange, eventually resulting in a free floating currency system. After the accord ended in 1971, the Smithsonian Agreement allowed rates to fluctuate by up to plus minus 2%. In 1961 and 62, the volume of foreign operations by the United States Federal Reserve was relatively low. Those involved in controlling exchange rates found the boundaries of the agreement were not realistic and so seized this in March 1973. When sometime afterward none of the major currencies were maintained with a capacity for conversion to gold, organizations relied instead on reserves of the currency. From 1970 to 1973, the volume of trading in the market increased threefold. At some time, that's according to Gundolfo during February-March 1973, some of the markets were split and a two-tier currency market was subsequently introduced with dual currency rates. This was abolished in March 1974. Reuters introduced computer monitors during June 1973, replacing the telephones and telex used previously for trading quotes. What was the market's close? Due to the ultimate ineffectiveness of the Bretton Woods Accord and the European joint float, the forex markets were forced to close sometime during 1972 and March 1973. The largest purchase of United States dollars in the history of 1976 was when the West German government achieved an almost $3 billion acquisition. That's a figure given as 2.75 billion in total by the statesman. This event indicated the impossibility of balancing of exchange rates by the measure of control used at the time, and the monetary system as well as the foreign exchange markets in West Germany and other countries within Europe closed for 2 weeks, and that duration was during February and March 1973, and it was closed after purchase of 7.5 million Danish marks. Exchange market had to be closed when they reopened on March 1. That is, a large purchase occurred after that close. That is another thing. Now, what happened to the world and foreign exchange markets after 1973? In developed nations, state control of foreign exchange trading ended in 1973 when complete floating and relatively free market conditions of modern times began. Other sources claim that the first time a currency pair was traded by United States retail customers was during 1982, with additional currency pairs becoming available by the next year. On 1st January 1981, as part of changes beginning during 1978, the People's Bank of China allowed certain domestic enterprises to participate in foreign exchange trading. Sometime during 1981, the South Korean government ended foreign exchange controls and allowed free trade to occur for the first time. During 1988, the country's government accepted the International Monetary Fund quota for international trade. Intervention by European banks, that is especially the Bundesbank, influenced the foreign exchange market on 27th February 1985. The greatest proportion of all trades worldwide during 1987 were within the United Kingdom, that's slightly over one quarter. The United States had the second highest involvement in the trading. During 1991, Iran changed international agreements with some countries from oil barter to the foreign exchange. As we have just discussed, the bulk of foreign exchange trading takes place on what's called as interbank market. Unlike other financial markets like New York Stock Exchange or London Stock Exchange, the foreign exchange market has neither a physical location nor a central exchange. The foreign exchange market is considered an over-the-counter market due to the fact that the entire market is run electronically within a network of banks continuously over a 24-hour period. This means that the foreign exchange market is spread all over the globe with no central location. Trades can take place anywhere as long as you have an internet connection. The foreign exchange over-the-counter market is by far the biggest and most popular financial market in the world, traded globally by a large number of individuals and organizations. In the over-the-counter market, participants determine who they want to trade with depending on trading conditions, the attractiveness of prices, and the reputation of the trading counterparty. The US dollar is the most traded currency, making up 84.9% of all the transactions. The euro's share is second at 39.1%, while that of the yen is third at 19%. If the US dollar is one half of every major currency pair and the majors comprise 75% of all the trades, then it's a must to pay attention to the United States dollar. Hence, the United States dollar is actually the king. In fact, according to the International Monetary Fund, the United States dollar comprises approximately 62% of the world's official foreign exchange reserves. What is a foreign exchange reserves? These are the assets held on reserve by a central bank in the foreign currencies. Because almost every investor, business, and central bank own it, they pay attention to the US dollar. There are a couple of other significant reasons also why that the US dollar plays a central role in the foreign exchange market. Why? Because one, the United States economy is the largest economy in the world. Also, the US dollar is the reserve currency of the world. Then the United States has the largest and most liquid financial markets in the world. The United States has a stable political system. The United States is the world's sole military superpower. The US dollar is the medium of exchange for many cross-border transactions. For example, oil is priced in United States dollars, also called petrodollars. So if Mexico wants to buy oil from Saudi Arabia, it can only be bought with the United States dollars. If Mexico doesn't have any dollars, it has to sell its peso first and buy US dollars. How does the speculation in the foreign exchange market happens? So one important thing to note is that the foreign exchange market is that while commercial and financial transactions are part of the trading volume, most currency trading is based on speculation. Most of the trading volumes comes from traders that buy and sell based on short-term price movements of currency pairs. The trading volume brought about by speculators is estimated to be more than 90%. The scale of foreign exchange market means the liquidity, the amount of buying and selling volume happening at any given time. That is extremely high in case of foreign exchange market. This makes it very easy for anyone to buy and sell currencies. From the perspective of a trader, liquidity is very important because it determines how easily price can change over a given period of time. A liquid market environment like foreign exchange enables huge trading volumes to happen with very little effect on the price or price action. While the foreign exchange market is relatively very liquid, the market depth could change depending on the currency pair of time of the day. So, let's learn about the different ways that individuals can see the individual countries find out the market size and liquidity in the foreign exchange market. As such, the foreign exchange market is the most liquid financial market in the world, as we have just discussed. Traders include governments and central banks, commercial banks, other institutional investors and financial institutions, currency speculators, other commercial corporations and individuals. According to 2019 Triennial Central Bank Survey coordinated by the Bank for International Settlements, average daily turnover was $6.6 trillion in April 2019 as compared to $1.9 trillion in 2004. Of this $6.6 trillion, the $2 trillion was spot transactions and $4.6 trillion was traded in outright forwards, swaps and other derivatives. Foreign exchange is traded in an over-the-counter market where brokers or dealers negotiate directly with one another, so there is no central exchange or clearing house. The biggest geographic trading centers is the United Kingdom, primarily London. In April 2019, trading in the United Kingdom accounted for 43.1% of the total, making it by far the most important center for foreign exchange trading in the world. Owing to London's dominance in the market, a particular currency's quoted price is usually the London market price. For example, when the International Monetary Fund calculates the value of its special drawing rights every day, they use the London market prices at noon that day. Trading in the United States accounted for 16.5%, Singapore and Hong Kong account for 7.6%, and Japan accounted for 4.5%. Turnover of exchange traded foreign exchange futures and options was growing rapidly in 2004 to 2013, reaching $145 billion in April 2013. Actually, that was the turnover which was little double from as in comparison to the April 2007 turnover. As of April 2019, exchange traded currency derivatives represent 2% of over-the-counter foreign exchange turnover. Foreign exchange future contracts were introduced in 1972 at the Chicago Mercantile Exchange and are traded more than to most other future contracts. Most developed countries permit the trading of derivative products such as futures and options on futures on their exchanges. All these developed countries already have fully convertible capital accounts. Some governments of emerging markets do not allow foreign exchange derivative products on their exchanges because they have capital controls. The use of derivatives is growing in many emerging economies. Countries such as South Korea, South Africa, and India have established currency future exchanges despite having some capital controls. This is bibliography for your references. Thank you very much for listening.